The group today has four business segments: engineering and construction, drilling, operations and maintenance, exploration and production. Historically, the engineering and construction segment was the biggest revenue contributor, followed by the drilling segment. Before 2018, these two segments were also the larger EBIT contributors. The performance over the past 12 years was not good. Revenue declined, there were 7 years of losses, and gross profitability had been on a downtrend. Crude oil prices are cyclical, making Sapura a cyclical company. From 2010 to 2024, there was an 87% correlation between Brent crude oil prices and Sapura revenue 3 years later. As oil prices declined, the order book and the gross profit margin declined. Sapura relied on debt to grow. From 2012 to 2015, total assets increased from 4 billion to 35 billion. Total debt went from 1.4 billion to 17 billion. Interest charges grew from 47 million to 638 million. All was fine when the business was good, but when the orders began to decline, the interest payment became a burden. Sapura began to have problems paying its debt. It reached a stage where it sought court protection and initiated a scheme of arrangement. This will probably mean that shareholders and creditors will have to take a haircut. Given the asset impairments and operating losses, the group today has a negative equity. My valuation model showed that to return to profitability, the group would have to restructure its debt as well as require a white knight. This means significant losses for the existing shareholders. Sapura's current financial problem is partly due to using debt to fund its acquisition. The oil and gas sector experienced declining crude oil prices soon after Sapura completed its major acquisitions. This reduced the number of tenders available. When orders began to dry up, the group suffered. At the same time, the group was bidding at non-viable prices. This was made worse by the impairments. The performance deteriorated to such a stage that it had to seek creditors' protection and became a PN17 counter, requiring it to come up with a regularization plan. The group is undergoing a turnaround. Unless you are a turnaround expert and understand the debt and corporate restructuring process, this is a stock to avoid. For more details, read the article. Thank you.